Alright everyone, Cowboy Trades here. Welcome back to the channel for another update on Bitcoin. So today's video is going to be a little bit different. We're going to split it up into three segments. Number one, we're going to talk about the Bitcoin technical analysis. What are my updated thoughts now we're closing beneath all of these key areas of support? Number two, we're going to talk about a Bitcoin trading strategy which I've back tested with statistical analysis over on Bloomberg. Easily the most profitable Bitcoin trading strategy, extremely simple, and I'm going to let you know how you can implement this for free over on TradingView. And then number three, for those of you who do stick around and understand the importance of the bond market, we're going to talk about just that. We're going to talk about what is happening right now with real yields. And for those of you who do watch this segment of the video, we're going to tie everything back into global liquidity, equities, bonds, and how this will all affect Bitcoin. Let's dive right into the video. So in terms of the Bitcoin technical analysis, it is not looking good. You can see we've printed a very, very bearish engulfing candle falling from this major resistance box, which we detailed in our previous videos. You can see we have broken the uptrending line of support, which has been holding up throughout all of 2023. We have had a weekly candle body close beneath this, the bull market support bands, the 200-week moving average, and the weekly EMA ribbons. Basically, we've closed beneath pretty much every single important level of support, except from this support box round about 24,400. So in the higher time frames, just like we talked about in our most recent video, this weekly close that we just had beneath all of these levels of support is very, very detrimental for the markets. And we do believe Bitcoin is going to get continuation back down. In terms of the total cryptocurrency market cap as well, you can see we've closed beneath all of these levels, just like Bitcoin has. We are very, very close to breaking down from this potential head and shoulders pattern, which will almost take us down into new bear market lows at 750 billion. If we do break the neckline in terms of the total altcoin market cap, we look pretty much the same as the total one, but instead of this looking like a head and shoulders pattern, which yeah, there is definitely the argument this is a head and shoulders pattern, I'm also seeing this being a potential M pattern. So I'll let you guys decide what you think this is. Either way, really, altcoin market cap is not looking good whatsoever right now, and neither is the total cryptocurrency market cap. If we come over to the next chart for Bitcoin and look at the oscillators, the weekly time frame is still turning down on the stock. Like we said, we think we have more room to go to the downside in terms of the weekly MACD. Histogram bars are stacking up, and we're picking up a lot of momentum since we talked about this very, very dangerous Bitcoin fractal. We talked about this quite some many weeks ago. If we do now head over to the monthly time frame, as you can see, the MACD is getting weaker and weaker and weaker. This is looking like a dead cat cross. We pointed out the fractal with this bullish flip over on the MACD on the monthly time frame and how this looks like this top that we saw in 2019. And we also highlighted on the monthly time frame, we're getting very, very close to a bearish flip on the stochastic RSI. So Bitcoin right now is not looking good whatsoever. What I'd love to see for Bitcoin right now is for us to have a pushback up to between 27,500 and 28,000. If we do look at the daily for Bitcoin, you can see the stochastic is pretty beat down right now. So, you know, at this moment in time, I wouldn't be shorting. I don't think we're from a position of strength. I would much prefer to see, as you can see, we have broken down from this head and shoulders pattern, the 2023 trend line, and all of these important levels, which we did detail in the previous video. What I would love to see at this moment in time is a bounce back up to the weekly EMAs, the bull market support bands, this massive, massive resistance box, basically all of these key levels between 27,500 and 28,000, and at which point I would be looking to short from a position of strength. I think that would be a great retest of all those key levels that we did just mention, and also a retest of the neckline of the head and shoulders pattern. So in terms of my price targets, you know what, I think in the higher time frames, I do think we're coming down to this CME gap at 20,200. I'm not necessarily saying that we do have to come up to 27,500 before we push back down further to the downside. What I am saying is at this moment in time, I won't be shorting. I would love to see a pushback up, fill this CME gap, which we've recently just created at 27,600, at which point, when we are solidifying a retest of all of these important levels, which I have been letting you know about, this is where I'm looking to enter a short. If we never hit that level and we just come plummeting to the downside, that's also okay with me. I'm on the sidelines until we see a position of strength. So there we go. That's the technical analysis for Bitcoin. Like I said, this shouldn't really come to a surprise for any of you who have been watching my videos for the past week or so. We prepped you for this in advance 2 or 3 days ago. We let you know exactly what our thoughts would be if we did close beneath this level. We're now just being patient and waiting for the market to make its next move. But let's now move into the second segment of today. today's video, where I'm going to be talking about the best Bitcoin strategy, completely undisputable. This strategy blows buying and hodling out the water. Let's just dive right into today's video. So over on the Bloomberg terminal, there's a function called the BTST function, and what this basically allows you to do is run some statistical simulations and backtest previous returns for multiple trading strategies. And this trading strategy right here on the daily time frame, the triangular moving average strategy, came in at number 1, and surprisingly buy and hold was all the way down here at number 10. Now I'm going to talk about later on in today's video, is buy and hold a bad strategy? Because I don't think buy and hold is a bad strategy, but at least for the purpose of this video, for those of you who are traders, we're going to talk about this moving average strategy and everything it entails. So this strategy is very, very simple. It relies on 2 rules and only 1 indicator. And also don't worry, you don't need a Bloomberg terminal to be able to access this moving average. I found it over on TradingView. You can get this for completely free. So let's talk about the strategy. Like I said, it relies on the 50 triangular moving average, and it relies on 2 rules that are very, very simple. Rule number 1. The triangular moving average strategy goes long when you witness a daily close above the 50 triangular moving average. Rule number 2, the triangular moving average strategy goes short when a daily candle body close happened beneath the 50 TMA. So with this strategy, you will always have a trade open because you'll either be above the 50 triangular moving average and you'll be in a long position, and when it finally comes and closes beneath the 50, you'll be in a short position, and you'll keep on pivoting between long positions, short positions, long positions, short positions. There's never a dull moment. You will always be trading based on this strategy. It is really just that simple. Long above the 50, short beneath the 50. Now, I didn't want to bore you by pulling up a bunch of correlation coefficients, statistical analysis, beta regression lines. So I'm just going to show you this one screen, which shows you since Bitcoin's inception up until this moment in time, using the daily time frame, if you're sorting these strategies by total return, triangular MA is the most profitable strategy with 1.18 trillion in profit, and buy and hold only being down here at 216 billion. So the triangular MA strategy boasts more than a 5x return from purely buying and hodling. However, this is where we're going to come back to buying and hodling, because if you're looking at the monthly time frame, and on this screen I'll just show you the quarterly time frame, buying and holding in the higher time frames is still the best strategy for the higher time frames. Now, as you can see, this is 609 billion worth of profit and loss rather than the previous 1.18 trillion with the triangular MA strategy. I personally think buying and hodling should have a position in everyone's portfolio. Not financial advice, I'm just going to be letting you know what I'm going to be doing. I'm going to be incorporating both the triangular MA strategy and the buy and hold strategy. Bear in mind, when we're running these simulations, you know, it's undisputable. This is just statistical evidence. You can't argue and say, oh, you know, buy and hold is a more profitable strategy. It's clearly not. The evidence shows triangular MA is a more profitable strategy, but this is only looking at things statistically. Now, I believe there are a lot of benefits of buying and hodling in the long term. For example, there might be situations in the future where your country makes Bitcoin illegal, and then all of a sudden you can't buy and hodl and you can't trade, and you probably would have just been better off buying and hodling. This is just one example. Once again, I plan on incorporating both of these strategies into my Bitcoin trading plan. Nonetheless, I just wanted to show you, not based on opinions, not based on speculation, based on pure mathematics, the best Bitcoin trading strategy. Once again, this is very, very simple. Over on TradingView, if you did want to run this strategy yourself, all you need to do is come over to indicators and type in this over here, triangular moving average. The one that I'm using is created by a user called Everget. You simply want to click on this moving average. You can see that when you originally load this in, it's going to have buy and sell signals. I personally prefer to smooth this out and not look at buy and sell signal. But what you're basically going to want to do is come over to the inputs and change the length to the 50. And just like that, you can see you have that moving average, and it will tell you on the daily time frame when to go long, and it will tell you when to go short. The only reason why I personally don't like to have the buy and sell signals is because this one is a little bit weird. For example, sometimes you can see over here, it just didn't go into the red when it should have gone into the red. So I prefer to look at this by eye and just have this as a plain color. If you wanted to change the color yourself, just click on the settings of this, go over to inputs, remove the highlight movements box, and then just change the color. This is color number 2 down here. Maybe you want an orange one because you're a Bitcoin maxi. You could make the line thicker, shorter. this is basically all you really need to focus on. Now, the 50 TMA strategy utilizes a 10x leverage. It doesn't use take profits. It doesn't use stop losses. Like we said, due to the nature of this, you are always in a trade. You are either longing the markets when you're above, or you are shorting the markets when you are below. Now, I do believe you could slightly improve this in your own way by fine tuning it. What I mean by that is, let's say you enter your trade. Let's say we start this simulation round about January. You found out about this on January the 1st. You saw your first close above the 50 TMA. You saw the markets rocket up 43%, and you said, hey, you know, I've made 4.3x return. Let me put a stop loss, maybe 400, maybe 300% in profit, at which point you can see the markets come back to the 50 TMA, have a positive reaction. You could have traded another swing to the upside when it closed beneath. You could have traded a swing to the downside. Once again, you know, you would have yielded 12% return on this. Maybe put a stop loss at 50% profit or something like that. So when the markets do push back up, you can get ready for that next close above. You can witness the markets push up 29%, a 2.9x return. And then once again, you could say, hey, maybe I'll put my stop loss into 2x return. There are ways that you can fine tune this. I will leave that to you though. This is definitely a strategy that I'm going to be keeping my eyes on. And you can see, if you were in this trade right now, because you can see you would have longed all the way up here. And once we had the daily candle body close right here, you can see we had 1, 2, 3, 4 retests of the moving average without closing above. So you'd still be in that short. If you were in that short using the 50 TMA strategy right now, the markets are down 10.6%. You're using a 10x leverage on a short position. You know, you've over doubled your position size. So this is definitely a very powerful strategy. But let's now move on to the final part of today's video. We're going to be talking about the bond markets, because at this moment in time, US 2-year bonds are currently yielding 5% returns, and UK bonds are currently yielding 5.5% returns. Over on the screen, it says UK bonds on the 2-year basis are yielding 5.15%. If you actually live in the UK and you go to a bank, they will give you 5.5%. I know, because I've just purchased some short duration bonds on a 2-year time frame. For example, Lloyds Bank, 5.5%. I'm sure if you're in America, you know, they're going to give you a competitive rate. They're going to give you more than what the Bloomberg terminal states. But let's talk about it. These short-term bonds are at the highest levels since 2008. The yields are absolutely through the roof right now, and that is why I am currently purchasing some 2-year government bonds. Now, basically, if we come over to this chart, you can see this is a 3D yield curve. If you are a short-term lender right now, so you can see the duration of these bonds down here, you've got 1 month, 2 month, 3 month, but I'm going to be focusing on 1-year and 2-year bonds. This chart seems very complicated, but we'll run through it. You can see the date of the expirations are down here, the duration of the bonds are down here, and over on the y-axis here, this is simply how much yield you'll get from entering these bonds. Now you can see there's a very nice sweet spot at this peak, round about 1 to 2 years, where you're going to be getting round about 5 to 5.5% return on your yield, and then it will start to drop off. So basically, if you have money and you're a short-term lender, the inverse yield curve right now that's sloping downwards is going to benefit you the most. Now, typically, yield curves do not slope down like this. Let's look at this in a 2D model, because it will make a little bit more sense when we take this into a 2D spectrum. Over on the y-axis, you can see the yield that you'll get from these bonds. Over on the x-axis, you'll see the duration of the bonds. So for example, over here, you can see the yield is exceptionally high if you're taking out yields and you're lending money in the short term. If you're lending money for 1 month, 3 months, 6 months, 1 year or 2 year, you are getting exceptionally high levels of yield. And then you can see it drops off. If you're lending for 5 years, you know, 10 years, 20 years, 30 years, you're not getting the same levels of yield as if you were lending in the short time. And I'll explain why it's like this in a second. But first of all, yield curves typically don't look like this. Yield curves don't typically slope downwards, they slope upwards. And this makes sense because the longer you're going to be lending money, remember the bond market is the market which finances governments and finances government deficits. If you are in the bond market and you're lending $1,000 to the US government to purchase, you know, let's say some 10-year bonds, you're going to be lending money to the government for 10 years. And because, let's say you're lending for 10 years, 15 years, 20 years, or even 30 years, the longer you're going to be lending this money out for, the more you're going to be like, hey, you know, I'm giving you my money for 10 years, 20 years, 30 years, you better give me a good return. So in the long term, typically a yield curve slopes upwards, and the longer you lend money to the bond market, or also known as, the government, then you're going to get a higher yield. That's just how it works. And if you're only lending money, let's say for a year, just so we're not going through all of these, let's say you're lending money to the bank for 1 year, and they're going to use that money to purchase bonds, and that money from the bonds is going to go to the government. So basically you're financing the government by purchasing bonds. That's why they're known as, 2-year government bonds, 3-year government bonds, etc. You get my gist. Let's say you're lending money for 1 year. Let's say you're lending money for 1 year because you just want to get a little bit of return because next year you're going to be buying a house. Now, you're going to put that money in the bank and you're probably going to take whatever they're going to give you. Let's say your bank is like, hey, we'll give you 2% if you give us this money for 1 year. And you're like, hey, I'm using this money to save. I need to buy a house in 1 year's time. I'd rather keep it in a bond, which is going to give me 2% return, than just leave it in my savings account, which is going to give me, 0.001% or whatever ridiculous amount that they're going to give you. So in the short term, you can't really expect high yield bonds, but in the long term, typically the yield curve slopes upwards because it compensates the lenders which lend for long periods of time. However, when you're coming into times of financial turmoil where short-term risk is exceptionally high, this is where you see the yield curve invert, because in the long term, the markets are saying, hey, in the next 20 years, in the next 30 years, the US is probably going to be fine. So lending money for this amount of time is probably not going to be a big deal. However, in the next 1 year, in the next 2 years, there's a significant risk of the US breaking into recession. There's a significant risk of a default. So in the short term, risk is so high that you are getting better yield in the short term than the long term because the yield curve is inversed and short-term risk is higher than long-term risk. And because of that, my friends, short-term government bonds on the 2-year time frame, whether you're in America and they're giving you 5%, or if you're in the UK and they're giving you 5.5%, remember, you can always invest in international bonds. If you are locking your money up for the next 1 or 2 years or so in government bonds, these returns are very, very attractive. And we're going to tie this all together because absolutely everything we've talked about today is intertwined. Everything starts off with economic data, which we'll call ED. Now, economic data affects economic policies. For example, if we see economic data coming in for the job market's very strong, the Fed might say, hey, because the job market's so strong, we can raise interest rates. And then let's say the Fed raised the interest rates using their economic policy. What will this affect? This will affect global liquidity. And when global liquidity comes down, what's going to happen is what we're going to call Y, which is yields. Yields are going to go up. When yields in the bond market go up and global liquidity is coming down and people are facing financial turmoil, what is that going to do for the equity markets? Well, considering the equity markets rely on financing global liquidity in order to, expand their enterprises, when global liquidity comes down, that is bad for the equity markets. And subsequently, when yields go up, people are saying, hey, why would I invest in the equity markets right now when I can get, 5 or 5.5% in the next 1 or 2 years by locking in some yield? So what happens is, following all of this, equity markets go down. What do the cryptocurrency markets follow? If we're looking at, Bitcoin, let's say Bitcoin's going to follow the equities. Bitcoin will also go down. What will then happen for altcoins? Altcoins will follow Bitcoin and Bitcoin will go down. So everything we've talked about today is absolutely intertwined right now, guys. While we haven't really talked about economic data and economic policies, we talk about this quite often in our channel. This is why we're so interested in what's happening in the bond market right now. We're seeing strong data come in for the US economy. This is meaning that the Fed can raise the interest rates and further crush liquidity. Global net liquidity is coming down. The prices of bonds are coming down, which is sending bond yields up. When bond yields go up, that's bearish for equities, because why would people in a extremely risk-on environment risk their money for negative returns in the equities where they can get real positive returns in the bond market? When equities go down, global net liquidity goes down. Bitcoin as well, as you can see, Bitcoin really loves global net liquidity. This is all intertwined. Bitcoin comes down and altcoins come down. And guys, to wrap up the video, global net liquidity is almost at bear market lows. So absolutely everything I talk about on this channel is intertwined. I hope I've done a good enough job explaining why we're so interested in these markets. What I will leave you on is one final picture. The US 2-year government bonds, while I do think they can push up a little bit higher, I do think this is a sweet spot for yield right now. And also, the yield curve is starting to double bottom, and it's looking like it potentially might want to push up a little bit. The reason why it's pushing up a little bit is because while the lower yields have been on a massive ramp to the upside recently, and they've been trending sideways and a tiny bit up for the past few months or so, if we're coming over to the higher duration end of the yield curve, we're actually seeing longer duration yields start to catch up to the upside. And remember, when we're looking at yield curves, when we're looking at something as simple as the 10-year minus the 2-year, when the 10-year starts to catch up at these levels, it's a very, very simple function, guys. When the 10 goes up, the yield curve is going to start reverting back to the upside. And just look at the yield curve. Look at what happens when you see the yield curve in the short term being inverse. When short-term risk is exceptionally high, you come over to the yield curve, this is what you see. You see short-term risk so high, and that's because it's a simple function. The 10-year minus the 2-year, let's say the 10-year is valued at 10 and the 20-year is valued at 20, you're going to see an inversion, you're going to see it come down. But then what starts to happen when you see long duration bonds start to catch up? Well, you start to see what was once an inversion start to revert back into positive territory. And every single time this has happened, this has been a harbinger of a recession. You can see this happen in the dot-com crisis, the 2008 financial crisis. This happened following, you all know what this is. And right now, there is significant short-term risk in the markets. That is why yield is so high in the short term. So for today, my friends, that's all I've got. Like I said, today's video, a little bit different. While we only talked about 3 different topics, we really wanted to go in depth talking about this new strategy over on Bitcoin. And I wanted to do a better job than I normally do explaining the importance of why we're always looking at the government bonds. I feel like potentially I haven't done the best job of explaining why I'm so interested in the mod market. Some of you recently might be like, why does he care about bonds? Why are we looking at 2-year bonds? Why are we looking at 10-year bonds? I probably haven't done the best job of explaining why the bond market is so interesting and why it's so important for the markets right now and why everything is so intertwined. Why we don't just look at Bitcoin technical analysis, why we don't just look at trend lines, why we don't just look at, technical analysis for Bitcoin. This is because everything, all of the markets are so intertwined, guys. And, my YouTube channel, I feel like I'm filling a niche. I feel like other cryptocurrency YouTubers don't talk about this chain reaction with all of the markets. So for today, that's all I've got. Hope you enjoyed the video. I'll see you in the next one, my friends. As always, if you did enjoy the content, make sure to let me know down below by leaving a like and a comment, share the videos with your friends. If you want to further support the channel, feel free to click the join button on YouTube and become a member today. It's been your boy Cowboy Trades. I'll see you in the next one. I'm out. Peace.